Today is Monday, August the 15th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, or ADM. Today's guests are Steve Freed, ADMIS Vice President of Grain Research, and Alan Bush, ADMIS Senior Financial Economist. Starting with the financials this morning, Alan, a lot of traders are looking at the yield curve. How important is the yield curve in assessing the economic outlook?
Well, the yield curve is extremely important, and right now the yield curve is inverted substantially between the one-year Treasury bill and the 10-year note by as much as 46 basis points. So that is severely inverted, indicating that there are some concerns about the economy going forward.
Alan, on Wednesday, the Fed will release the minutes from the July 27th FOMC committee meeting. What will these minutes reveal?
Well, I think the Fed will be very hawkish in what they were thinking at their July meeting, and that has followed through even into the last week or so, where they remain still very hawkish in their rhetoric, even though we did have some inflation numbers, in fact, too, the CPI and PPI, coming in substantially less than anticipated. But overall, the Fed remains steadfast in their hawkishness, and I think that will be the case in what we see in the minutes from the Fed.
Now, before I turn to the grain markets, can you tell us, it looks like the stock market has found some legs. What's your opinion for stock futures in the short term?
So in the short term, we are seeing a pattern of futures performing very well, even though we have had some negative news. Of course, the Fed being very hawkish, raising rates, likely to raise rates more. And also today we had an index, the New York Fed index, the Empire State Manufacturing Index, coming in at a very negative number, negative 31.1, when positive 5 was expected. So a lot of negative news overall, and a lot of reasons for this market to go down, but it has not. So that would suggest that we are likely to see some gains, at least over the near term, in stock index futures.
Thanks, Alan. Steve, looking at the grain futures, last week we rallied before and into the USDA report. Today we're sharply lower. Why is this, and do you feel the sell-off will continue?
I'm afraid I think it will. We're trying to establish a trading range in the grains. USDA rally into the USDA report was hope that they would lower crop size and lower carryouts, at least for the corn and beans. And then we were looking at a weather forecast that might be warm and dry over about 40% of the Midwest. And what the USDA actually did was, in the corn, they raised this year's carryout 20 million bushels, but they did lower the yield and lowered next year's carryout. But still, the corn market's trying to evaluate how much corn is going to be out of Ukraine. On soybeans, they raised next year's carryout due to a higher crop. And in the wheat, slight drop in the wheat carryout. But today, we're dealing with three issues. The maps are in agreement of rain in the dry areas this week: South Dakota, Iowa, Missouri, and then China announced they no longer were going to take grain and ag products from New Zealand and Australia. There's no disease issue. It just seems like there's politics involved, and the market's afraid that if China doesn't need New Zealand dairy or wheat and beef from Australia, do they need U.S. beans or U.S. pork? And then China economic data in July was negative. Everything was down. And so they had to cut interest rates on two key interest rates to try to shore up their economy. And so that, again, suggests to, like, the crude oil market, the grains, even the precious metals, that China import demand might come down.
Yeah, what did the USDA say, Steve, about demand and competition for U.S. grain exports, especially wheat?
I think the main thing was they increased the Russian wheat crop 8 million tons to 88. Some people think it's as high as 95. They increased exports to 42 million tons. But June, July Russian exports are about 2 million tons behind a year ago. We think they can only ship 3 million tons a month. So that's based on logistics and insurance and freight. So I think the market may have overreacted to the increase in Russia. We're still looking at the cheapest corn in the world is out of Brazil. And then as far as beans are concerned, China's not buying our beans. So I think the report was basically a little negative. We did rally after the report on some consumer buying, but I think that all this information keeps us in a trading range.
One more thing, Steve, can you speak to the current fund position and also what do the technicals look like right now for those technical traders?
A week ago, the funds had their smallest position in the grain market since May. May, they liquidated positions because of the Fed attack on interest rate inflation by increasing interest rates. So some people think that we put a top in the bean market around this $15.50 area and might settle into a $14, $15 range until we know more about the demand side of things. Corn, $6 to $6.50 has been a range since 1st of June. Will probably stay in that range. And the wheat market, I think it's undervalued here at these price levels, but we've been sideways between $7.50 and $8.50 since June 1st. So I don't really see any reason why the market needs to break out on the upside of that or break on the downside of that.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.